So I want you to picture two neighboring countries,
Okay.
not just any countries on a map, but two absolute economic leviathans. I mean, they share this trillion-dollar economic bond that is so deeply intertwined, it's basically the central nervous system for an entire hemisphere's manufacturing capability.
Right. We're talking massive scale here.
Exactly. Ships are crisscrossing their shared waters every single day. Factories in one country are completely reliant on specialized components from the other. Millions of jobs, like whole cities really, just hang in the balance of this relationship.
It's a huge machine.
Yeah. Now imagine a totally unexpected, highly localized, and honestly relatively minor accident at sea. Two boats bump into each other.
A fender bender, basically.
Right. So why would that single isolated event instantly turn the global financial markets into a meat grinder? I mean, evaporating billions of dollars in corporate market value literally overnight.
It sounds like a bad movie plot, honestly.
Yeah.
You have this massive, complex machine of global trade, and you just naturally assume it has shock absorbers.
You would think.
Right. You'd think a relationship worth trillions of dollars would be immune to, like, a localized political spat or a border disagreement. The assumption has always been that these ties are just too big to fail.
Yeah, that they're insulated.
Exactly. But the reality we are looking at today proves the exact opposite. Those deep economic ties don't act as shock absorbers at all. They actually become the very conduction wires that deliver a lethal financial voltage straight to the heart of these economies.
It's terrifying when you really look at it. And, when you read the news about territorial disputes or diplomatic spats, it is so easy to get caught up in the politics of it all.
Oh, for sure. Who's right, who's wrong? The historical grievances.
Right. But what fascinated me about the research we are unpacking today is that it completely ignores the politics. We are strictly looking at the cold, hard, mathematical data of how political shocks just destroy corporate value.
Yeah, stripping away the noise.
Exactly.
Yeah.
We are not taking sides on any of the historical or territorial disputes we are going to cover today. We are using this financial X-ray to look past the rhetoric and show you the hidden trillion-dollar bill of geopolitical conflict.
And that neutrality is really the only way to actually see the mechanics of the destruction.
Yeah.
The research we're relying on is this monumental study published in the Review of Financial Studies. It's by Raymond Fisman from Columbia, alongside Yasushi Hamao and Yongxing Wang from the University of Southern California.
These are heavy hitters.
Absolute top-tier scholars. And what they did was essentially take a sledgehammer to one of the most comforting myths of the modern era.
You're talking about the idea of cold politics, hot economics.
That's the one.
This was the golden rule I was taught in school. The idea that two nations can absolutely despise each other on a diplomatic level, their politicians can yell at each other on television, but underneath it all, the business community will just keep quietly making money.
Right. The prevailing theory for half a century was that capital is this perfectly rational force that insulates itself from emotional geopolitical noise.
Money talks, politics walks.
Exactly. If there's a dollar to be made, the market will find a way to make it, regardless of what the politicians are saying.
Right.
But Fisman, Hamao, and Wang proved that this common sense is just completely broken. It's a total illusion.
And they didn't do it by looking at high-level GDP numbers, right?
Yeah.
Which is what most economists were doing at the time.
No, because if you look at national GDP to understand a trade conflict, it's like looking at a forest from a satellite to understand why one specific species of beetle is dying.
Yeah, it's just too blurry. It tells you nothing about the actual mechanism.
Exactly. So instead, these researchers tracked the micro-level production, the sales, and the daily trading data of over 2,000 listed companies across China and Japan. And they mapped this data over several years.
2,000 companies. That is a mountain of data. But wait, I have to ask. Because globalization was supposed to be the ultimate shield. We were told that cross-border investment and deeply integrated supply chains were a buffer.
That was the promise.
So are you saying these companies, with all their wealth and all their influence, are essentially just held hostage by the geopolitical climate?
The microdata is the smoking gun here. It demonstrates that integration doesn't protect a multinational corporation. It actually exposes them.
Wow.
Yeah, the deeper the integration, the more severe the vulnerability. And to actually see how this plays out in real time, we have to look at the first major data set they analyzed, which takes us back to 2005.
Okay, let's unpack this, because this is where the story gets incredibly surreal. The trigger for this massive economic earthquake wasn't a bank failing or a currency collapsing or some massive tariff being signed into law. It was a textbook. Literally, A few edited sentences in a high school history textbook. I mean, how does that cause stock markets thousands of miles apart to crash?
To understand the financial panic, you really have to understand the specific historical context.
Hmm.
In April 2005, the Japanese government approved a revised edition of a history textbook.
Right.
Now, critics in China and South Korea argued that this specific textbook whitewashed certain historical events and atrocities from World War II. And the reaction to this wasn't just a few strongly worded letters from diplomats.
No, it's spilled right out of the embassies and into the streets. I mean, we saw massive nationwide protests erupt across major cities in China.
Right. But from a purely financial perspective, if that cold politics, hot economics theory held any water, the stock markets in Tokyo and Shanghai should have largely ignored this.
Because institutional investors are trained to separate cultural or historical disputes from, like, the quarterly earnings projections of a semiconductor manufacturer.
Exactly. They're supposed to be cold and calculating.
Huh.
But they didn't ignore it. Following the textbook event, the Japanese Nikkei index plummeted 6.1%.
I just want to pause on that number for a second. A 6.1% drop for an entire national stock index is catastrophic.
It's massive.
That is hundreds of billions of dollars of wealth just evaporating.
Yeah.
But I have to play the devil's advocate here for a second. Markets fluctuate, right? April 2005 could have just been a bad month for the Asian economy as a whole.
Sure, that's a fair question.
Maybe tech stocks were having a bad week or oil prices spiked. How do we know it was the textbook that caused the drop?
That is exactly what the researchers needed to isolate, which is why they used a control group. During that exact same window, while the Nikkei dropped 6.1%, the Shanghai Composite in China dropped 5.3%.
So they went down together.
It was a perfectly synchronized dual market crash. Meanwhile, the U.S. S&P 500 barely blinked. It dropped only 1.4%.
Oh, wow. So the broader global market wasn't panicking at all.
Not at all. This was a highly localized, perfectly synchronized financial bloodbath. And it was triggered by a non-economic, purely cultural event.
It is genuinely wild to think about. It's a financial earthquake where the epicenter was a printing press.
It really is.
But as crazy as the 2005 textbook storm was, the researchers also looked at a second event in 2010. And the trigger here is arguably even smaller, a single fishing boat.
Right. September 2010. A Chinese fishing trawler collided with Japanese Coast Guard vessels near the disputed Diaoyu or Senkaku Islands.
Okay.
And following the collision, the Japanese authorities detained the fishing captain.
One captain. One guy driving a fishing boat gets detained. And somehow, multinational corporate giants companies that manufacture the world's electronics, cars, and pharmaceuticals, they just grind to an absolute halt. I struggle to wrap my head around the physics of that.
The diplomatic fallout was instantaneous. China employed severe diplomatic pushback, demanding the captain's immediate release. Ministerial-level meetings were completely canceled.
So they just ghosted each other.
Essentially, yes. The two governments stopped speaking. Eventually, Japan compromised and released the captain, explicitly citing the impact on Sino-Japanese relations. But the standoff created a 53-day capital market freeze.
53 days where billions of dollars are just trapped in geopolitical purgatory. I was trying to come up with a way to visualize this for you guys listening.
It's tough to picture.
Right. Imagine two massive multi-billion-dollar corporations sharing an office building. Two entry-level employees get into a minor fender bender in the parking lot. It's a scraped bumper.
A total non-issue.
Exactly. But instead of exchanging insurance information, the CEOs of both corporations instantly freeze all their bank accounts, lock the doors, and completely sever all business ties. It defies every single rule of rational capitalism.
It seems completely irrational until you look at the mechanics of the punishment. And to understand how this freeze actually destroyed wealth, we need to dive into what the researchers identified as the China poison for Japanese companies.
Okay, here's where the methodology gets incredibly granular. We're looking at Japanese corporate giants, the ones who were aggressively expanding into China, opening factories, building these massive sales networks.
The ones making the most money.
Right. They were making the absolute most money in this booming market. And yet the data shows they became the very first targets for investors to dump.
Yeah.
Why did success turn into a liability?
Because in a geopolitical crisis, exposure becomes a toxic asset. But to prove this, the researchers couldn't just look at raw stock prices. They had to use something called the Fama French three-factor model to clean the data.
Okay, wait. We promised no academic jargon, so we need to translate FAMA French three-factor model into something human.
Fair enough. Think of it as a highly advanced financial X-ray.
An X-ray that filters out the normal noise of the stock market.
Precisely. The stock market is always moving based on a million different variables, interest rates, currency fluctuations, global trends.
Yeah.
If you're testing a new fertilizer on a plant, you need to make sure the plant isn't just growing because it suddenly got more sunlight. The FAMA French model calculates what a stock should have done on any given day based on normal market gravity.
Ah, okay.
It filters all that normal gravity out. What you are left with is the exact financial bleeding caused solely by the political shock of the textbook protest or the boat collision.
So it isolates the geopolitical damage down to the decimal point. That's brilliant. Lay the math on us. What did the X-ray show for these highly successful Japanese firms?
During the 2005 window, the math was just brutal. For every 10% increase in a Japanese firm's sales to China, their stock took an extra 0.8% dive.
Wait, a 0.8% extra penalty just for doing business? If you're a casual listener with a retirement account, 0.8% might sound like, I don't know, a bad Tuesday.
Right, sounds small.
But we are talking about conglomerates worth tens of billions of dollars.
We are talking about hundreds of millions of dollars in market capitalization wiped off the ledger. And here is the crazy part. They didn't lose this value because their supply chains failed.
Right.
They didn't lose it because they released a bad product or had some accounting scandal. They lost it simply because they had successfully penetrated the Chinese market.
High reward instantly transformed into a high target on their backs.
Exactly. Having a massive Chinese sales division became a poison pill for the stock.
But the pain wasn't a one-way street. And this brings us to a massive anti-common sense moment in the data. Let's look at 2005 again.
All right.
The conflict is sparked by a Japanese textbook. The protests are happening in Chinese streets. The anger is entirely directed at Japan. Logically, conventional wisdom dictates that Japanese companies must have taken the brunt of the damage, right? I mean, they are the targets of the protests.
That is the logical assumption, and it is completely wrong. It's a total slap in the face to what you'd expect.
Wait, really?
Yeah. The Chinese domestic companies, firms headquartered in China, employing Chinese workers, but exporting goods to Japan, they suffered equally horrifying symmetrical market punishments.
I find this absolutely mind-bending. The people protesting in the streets were inadvertently triggering a financial shockwave that was devastating their own country's exporters.
The symmetry in the data is staggering. The export exposure coefficient for Chinese firms hit negative 8.745.
Okay, let's break that number down so we can visualize it.
It basically means that the financial bleeding, the sensitivity to the crisis for a Chinese exporter, was nearly identical to the punishment suffered by the Japanese companies operating in China.
Wow.
The capital markets priced the risk symmetrically for both sides.
It's like two people in a three-legged race getting into a fistfight. You throw a punch at your partner, but because your legs are tied together, you both fall down and break a collarbone.
That's a perfect way to put it. There is no winner. It is mutual assured financial destruction.
But why would investors dump Chinese companies?
Yeah.
The protesters aren't boycotting Chinese goods.
Because investors aren't looking at the political morality of the dispute, they're looking at the fragility of the revenue stream.
Right, the money.
If you are an investor in a Chinese company that makes 40% of its revenue selling components to Japan, and suddenly the two countries are in a diplomatic freeze, you don't care that the Chinese company is the home team.
You just know that 40% of their revenue is now at massive risk of tariffs or border delays or retaliatory boycotts.
Exactly. Both sides of the trade ledger become equally toxic.
Which perfectly transitions us into the ultimate mystery of this entire study, the mechanism. Who or what actually pulled the trigger on these stock crashes?
This is where it gets really interesting.
Because we all saw the news footage in 2005 and 2010. It was impossible to miss. Angry consumers, massive street protests, smashed electronics, boycotts of specific brand name stores.
Right, very visual.
Naturally, you watch that on the evening news and you say, well, there's the answer. The consumers got furious, they stopped buying Japanese goods, revenue plummeted, and the stocks crashed. Did the mob cause the massive wipeout?
The data gives us an unbelievable, resounding no.
I'm sorry, what? The protests didn't cause the stock crash. We literally just talked about how sales exposure led to massive drops.
The exposure led to the drops, but the consumer protests were not the primary engine of that financial destruction.
That's wild.
The researchers brilliantly split the data to solve this exact mystery. They needed to figure out if it was irrational consumer boycotts driving the financial pain, or if it was something much quieter, like systemic government intervention.
So they had to mathematically isolate the angry mob from the state bureaucrat.
Exactly.
That sounds impossible. How do you separate the financial impact of a guy smashing a camera in a public square from the silent, behind-closed-doors actions of a government official? They're happening at the exact same time.
You look at where the financial blood is flowing from by categorizing the industries. The researchers separated the Chinese market into sectors dominated by state-owned enterprises, SOEs, where the government holds the reins, and sectors that were mostly private and consumer-driven.
Oh, I see.
They then mapped the Japanese firms against these sectors to see who took the biggest hit.
So if a Japanese company wants to survive a political clash, the data should tell us whether they need to hide from the consumers or hide from the government.
And the data points the finger directly at the government. Let's look at the 2005 numbers.
So,
At the time, the construction sector in China was heavily dominated by state-owned enterprises. SOEs held about a 26% share of the market. The Japanese construction and heavy machinery firms operating in China saw a massive 2.85% value wipeout above the norm.
it was a brutal targeted strike.
Exactly.
So the companies selling to the government got hammered. Now,
Yeah.
compare that to an industry where the government doesn't have a massive footprint. What happened there?
Pharmaceuticals. In 2005, the Chinese pharmaceutical market was mostly private. SOEs only had a 6% share of the market.
Okay, so mostly private buyers.
Right. And Japanese pharma companies. They barely got a scratch. Their abnormal drop was only 0.66%.
Wow, a quarter of the damage. That is incredible. The pain wasn't random at all. It wasn't just a blind mob lashing out at anything with a Japanese logo on it.
No, it was a sniper shot.
Where the state had leverage, where the SOEs were the primary buyers, the damage to Japanese corporate value was severe. Where the state had little footprint, the companies largely rode out the storm.
But this raises a fascinating mechanical question. How exactly did the state execute this sniper shot?
Right.
It's not like the Chinese government held a press conference, slammed a gavel, and officially banned the purchase of Japanese construction equipment.
Right. There were no official sanctions. No trade embargoes were signed by the WTO. There were no new tariffs announced on the evening news. So how do you choke off an entire country's imports in a matter of days without anyone noticing?
You do it through a stealth procurement shift. We are talking about hundreds of billions of dollars quietly changing hands.
Stealth procurement. I like that phrase.
The researchers dug into the highly detailed, micro-level Chinese customs data, millions of individual import declarations. And they found that right after the 2005 event, Chinese SOEs quietly dropped their Japanese imports by 0.7 percentage points compared to goods they were buying from the U.S.
So nobody held a press conference. There was no grand political theater. They just silently changed the supplier on a procurement spreadsheet, and billions in value evaporated from the Japanese stock market.
That is the power of state capitalism. When the state controls massive levers of the economy, like the procurement budgets for nationwide infrastructure projects, railway expansions, or municipal construction, they don't need a loud public political declaration.
They can just pull the strings.
Right. They can inflict catastrophic economic pain just by quietly shifting their purchase orders from Company A in Tokyo to Company B in Chicago or Munich.
That is absolutely terrifying if you were a corporate executive,
Yeah.
because you can't PR your way out of that.
No, you really can't.
If consumers are mad at you, you can run a friendly ad campaign, you can offer discounts, you can apologize, but you cannot run an ad campaign to win back a state procurement officer who has been given a silent internal directive to stop buying your steel. You are just dead in the water.
You are incredibly vulnerable, but, and this is where the research gets incredibly nuanced, there was a way for some Japanese companies to protect themselves. There was essentially an immunity badge.
Okay, this I need to hear. Amidst the absolute worst of this political freeze, when the sniper shots are taking out heavy machinery and construction companies left and right, why did some Japanese stocks not only survive, but stand rock solid? What was the shield?
It all came down to human capital.
Employees.
Exactly. The data showed that Japanese firms with a high percentage of local Chinese employees saw significantly less stock dropping. The average across these firms was around 15.5% local employment. But the higher that percentage went, the safer the stock became.
So hiring local workers became the ultimate corporate bulletproof vest.
What's truly illuminating here is that it proves governments act rationally, even when their citizens are highly emotional and the diplomatic rhetoric is explosive.
Oh, that makes total sense.
Right. The Chinese government, amidst all the nationalist fervor of 2005, still had a primary rational domestic objective, protecting local jobs and maintaining social stability.
The logic is just so cold and calculating. The state is looking at the board and saying, we want to punish Japan, but we can't crush this specific Japanese electronics manufacturer because they employ 50,000 of our own citizens in a factory in Shenzhen.
Exactly.
If we bankrupt them with a stealth boycott, we create a massive unemployment crisis in our own backyard.
Economic retaliation is a weapon, but a rational state won't use a weapon if the blast radius is going to decimate its own workforce. High local employment essentially tied the Japanese company's survival directly to the Chinese government's mandate for domestic stability.
They became too painful to kill.
Precisely.
That is such a vital insight for any multinational company operating today. Your best defense against geopolitical risk isn't just a diverse supply chain, and it's not a lobbying firm in the capital. It's deeply embedding yourself into the socio-economic fabric of your host country. You have to make your survival beneficial to the local government.
It's the ultimate insurance policy.
But I want to pivot back to those noisy street protests because the data reveals another massive illusion here.
You're talking about the fake fire of vocal boycotts.
Exactly, because earlier we established that the real damage was the silent state intervention via SOEs. But what about the smashed cars? The world watched people overturning Japanese cars, smashing Japanese cameras in the streets. Surely the companies making those specific consumer products took a massive hit.
It seems obvious, doesn't it?
I mean, if I'm a Japanese automaker and my cars are being set on fire on the evening news, my stock has to crater.
You would absolutely think so. It's the most intuitive conclusion you could draw. But the stock market completely ignored it.
Wait, really?
Yeah. To prove this, the researchers divided the Japanese companies into two groups. B2C, which is business-to-consumer companies like Sony, Panasonic, or Toyota, and B2B, business-to-business.
Right. The B2B companies are making industrial parts, chemicals, specialized heavy machinery, stuff the average person on the street never buys, never interacts with, and probably doesn't even know the name of.
Exactly. Now, if the consumer boycott was the main driver of the financial pain, the B2C companies should have plummeted, because their logos are the ones being targeted. Meanwhile, the anonymous B2B companies should have remained relatively safe.
That's the logical assumption.
But the data showed no statistical difference in the stock drops between the two groups.
Let me get this straight. The boycotts were incredibly loud. They dominated the global news cycle. They made for great television. But financially, they were completely hollow.
The real damage was entirely B2B, hidden from the news cameras, driven by those silent SOE spreadsheet changes we talked about. The financial markets are incredibly unsentimental.
Yeah, they don't care about the optics.
Exactly. Institutional algorithms essentially looked at the mob smashing a TV and calculated, that's noise. The real threat to the balance sheet is the state-owned enterprise quietly canceling a $500 million order for industrial turbines.
That is just wild. The market completely discounted the visual drama of the boycott.
Right.
But, and there's a huge but here, the consumer dynamic flips entirely when we look at the 2010 event from the Japanese perspective.
Yes, the data on Japan's silent backlash in 2010 is one of the most chilling findings in the entire study.
During the 2010 boat collision, the Japanese public seemed totally calm. If you watch the news in Tokyo, there were no smashed Chinese goods, no street riots, no viral videos of people burning flags.
Right, completely different reaction.
But suddenly, Chinese consumer exporters started bleeding out on the stock market. If there were no protests, what was driving the drop?
The Japanese consumer didn't riot. They didn't make a scene. They just quietly, ruthlessly stopped buying Chinese products at the supermarket.
A silent punishment.
Lethally effective. The data shows that Chinese B2C exporters, the ones selling consumer goods directly to Japan, suffered a catastrophic stock drop. We're talking about a coefficient of negative 31.015.
Wait, a coefficient of negative 31. That's insane compared to the single-digit numbers we were looking at for 2005.
It is a massive multiplier, and it highlights a profound cultural and structural difference in how different populations express geopolitical anger economically.
So the Chinese protests in 2005 were highly visible, vocal, and politically charged. But ultimately, they didn't translate into catastrophic long-term consumer shifts that the market cared about.
Right. People protested and then eventually went back to buying the electronics they liked.
But the Japanese public in 2010, they didn't make a sound. They just walked down the aisle of the grocery store, looked at the label, saw it was imported from China, and quietly put it back on the shelf.
Yes, and that invisible choice, multiplied by millions of individual shoppers day after day, absolutely devastated the Chinese B2C exporters.
It proves that consumer boycotts are not created equal. A loud, disorganized boycott can be financially irrelevant, while a silent, disciplined, sustained shift in purchasing habits can act as a financial guillotine.
Exactly. The silence was deadly.
Okay, we need to talk about the anatomy of a stock market stampede. Because we've talked about the state pulling levers, we've talked about consumers silently changing their habits, but what about the actual investors buying and selling the stock? Who is hitting the sell button and driving these prices into the ground?
This brings us to the emotion multiplier. What dictates if a multinational survives a political storm? You'd think it would be their balance sheet, their cash reserves, or the quality of their corporate governance.
But according to this research, it's none of those things. It's entirely dependent on how many retail day traders own their stock.
The researchers looked at the ownership structure of the Japanese firms. They separated the institutional investors, the massive pension funds, the professional hedge funds, the algorithms, from the retail investors.
Right, the retail investors being the mom and pop day traders sitting at home managing their own portfolios.
Exactly. And the difference in behavior between a hedge fund and a guy trading on his lunch break is staggering.
I can imagine.
It dictates the entire curve of the crash. For every 1% increase in retail investors holding a Japanese firm's stock, that stock's sensitivity to the conflict jumped by a coefficient of 1.62.
So just having a slightly higher percentage of regular people owning your stock makes the company vastly more jittery during a crisis.
It gets worse. If a firm had more than 5% of its stock held by retail investors, its sensitivity exploded. The coefficient went to -36. It's an absolute cliff edge.
So mom and pop investors are basically acting as an emotional accelerant. They're creating a blind stampede that even the cold, calculating professional investors couldn't stop.
Yes.
But why? Institutional investors are managing billions. Shouldn't they be able to absorb the panic of the retail traders?
You have to look at the psychology and the information diet of the retail investor. Institutional investors are trained to look at fundamentals. They might see a political crisis, calculate the actual revenue at risk, look at the historical data, and decide to hold the stock or even buy more if they think the price drop is an irrational overreaction.
Right, buy the dip.
Exactly. But retail investors, they are reading the headlines. They feel the nationalist tension. They are susceptible to the fear-mongering on the evening news.
They see the news about the detained fishing captain. They see the diplomatic meetings canceled. They see the talking heads saying war is imminent. And they just hit the sell button on their brokerage app because they want to purge the geopolitical anxiety from their portfolio.
It's purely emotional risk management. And when enough of them do it simultaneously, especially in stocks where they hold a critical mass of over 5%, it creates a self-fulfilling prophecy of value destruction.
Wow.
The mom-and-pop investors essentially burn down their own house because they smell smoke in the neighborhood. They create the very crash they were trying to avoid.
But surely the institutional investors step in eventually, right? The market panics all the time. Someone sneezes at the Federal Reserve, the market drops 500 points, and then 3 days later it bounces back because the professionals realize it was an overreaction and swoop in to buy the undervalued assets.
You're describing the dead cat bounce? The financial theory that even a dead cat will bounce if it falls from high enough? It implies a reversion to the mean, a correction of the panic once cooler heads prevail.
So did the dead cat bounce in 2005 and 2010? Did the stocks recover after the political tensions cooled off? Because eventually, the caption was released, the textbook protest died down, the news cycle moved on, the conflict ended. Did the money come back?
No, and that is what makes these events so terrifying for economists. 60 trading days after the events completely ended, there was zero price reversion.
Zero. So the professional investors didn't swoop in, the billions of dollars are just gone.
The money didn't come back. The short-term shock had mutated into permanent value loss. The market had fundamentally reevaluated these companies and decided that the geopolitical risk wasn't a temporary glitch. It was a permanent new tax on their existence.
I have a really hard time accepting this. If the protests stop and the spreadsheet changes are reversed, why doesn't the stock go back up? Are institutional investors just being overly dramatic? Why would they permanently devalue a company that is still building tractors or making medicine?
Because stock drops are not just paper illusions. This leads us to arguably the most devastating data point in the entire study.
Lay it on me.
The market wasn't overreacting. The market was perfectly predicting a collapse in actual real-world physical business profits.
So we aren't just talking about share prices anymore. We are talking about return on assets, or ROA.
Exactly.
Let's translate that for the listener really quick. ROA isn't your stock price. ROA is your actual ability as a business to take your physical factories, your patents, your cash, your workforce, and generate real profit.
It is the ultimate fundamental measure of corporate health. It's the engine of the business. And the researchers looked at the ROA for these companies in the year following the 2005 shock. High China exposure Japanese firms saw their next year ROA drop by 4.8%.
A 4.8% drop in actual profit-generating ability. That is a massive hit to the bottom line for a conglomerate.
But look at the Chinese side, because the symmetry holds true in the physical world too. High Japan exposure Chinese firms suffered a devastating 13.2% drop in ROA.
Let's just pause and absorb that number. 13.2% of a company's total ability to generate profit from its assets evaporated.
It's stunning.
If a company is operating on a tight 5% or 8% profit margin, which many manufacturers do, a 13% drop in ROA isn't just a bad quarter. That is a catastrophic structural failure. That means factories are sitting idle. It means inventory is rotting in warehouses because the borders are slow. It means massive layoffs.
The stock market in 2005 didn't just panic. It was looking into the future and correctly diagnosing a permanent bleeding wound in the actual supply chain.
So the political shock broke the physical machinery of commerce.
Yes. The friction introduced by the diplomatic freeze, the delayed customs checks, the canceled contracts, the shifting of suppliers, it all manifested as a permanent destruction of efficiency.
So what does this all mean? We've gone through this incredible microdata. We've seen how state-owned enterprises act as silent assassins, how Japanese consumers stage silent boycotts, how retail investors create stampedes, and how real physical profits are wiped out.
We've covered a lot.
But everything we've talked about so far has been focused on the giant publicly listed companies, Sony, Toyota, the massive Chinese construction and pharma conglomerates.
Right. The company's big enough and transparent enough to have their data tracked by Columbia University researchers. But we have to realize they are just the tip of the iceberg.
The silent majority in the deep. What about the tens of thousands of unlisted, invisible small businesses hiding underneath the supply chain iceberg?
The ones nobody writes headlines about.
Yeah. The mom-and-pop factory in Osaka making a highly specific screw for a Toyota door handle. The small logistics company in Shenzhen moving boxes from a warehouse to the port. What happens to them when the 13.2% ROA drop hits the giants?
This is where the human cost of geopolitical conflict becomes truly incalculable. Those unlisted small and medium enterprises, or SMEs, they have absolutely no financial shock absorbers.
None.
A giant multinational can issue bonds, take out massive lines of credit, or shift capital from their European division to cover a loss in their Asian division. They can bleed for a year and survive.
But the screw manufacturer in Osaka,
If their purchase orders get canceled because of a silent SOE procurement shift up the chain, they miss payroll on Friday. They default on their bank loan on Monday. They go bankrupt by the end of the month.
it's that fast.
When the geopolitical conflict hits, these SMEs face an immediate existential threat. The researchers couldn't track their stock drops because they don't have stock, but we can infer that the carnage below the waterline of that iceberg was absolute. Thousands of businesses likely vanished without a trace in the data.
And this brings us to a really uncomfortable realization about the nature of these two economies and how they fight. It's institutional warfare. We touched on this with the SOEs, but let's zoom out. Why was China able to perfectly execute a targeted economic strike in 2005 while the Japanese government was essentially left entirely toothless?
It comes down to the fundamental architecture of their economic systems. China operates with a massive state-owned enterprise network. That network isn't just about building bridges or refining oil. It acts as a hidden, incredibly powerful lever for foreign policy.
So the Chinese government can instantly mobilize economic resistance without ever passing a single public law or declaring a sanction. They just pull the SOE levers and billions of dollars shift overnight.
It's built into the DNA of the system. State capitalism allows for weaponized procurement. The government can draft the economy into a geopolitical conflict. Japan, on the other hand, operates a purely free market setup.
All right.
The Japanese government doesn't own the construction companies or the electronics firms. They have no levers to pull. If the Japanese government is angry at China, they can't secretly order Toyota to stop buying Chinese steel.
Because Toyota would laugh at them. They'd say, we have a fiduciary duty to our shareholders to buy the cheapest, most efficient steel, regardless of your diplomatic spat.
Exactly. So it becomes an asymmetric war. One side has a centralized control panel to redirect billions of dollars of trade to punish its rivals, and the other side just has to sit there, watch the free market react, and hope their companies survive the storm.
This raises a massive existential question about the future of global trade. Is the golden age of globalization dead and buried? Because for decades, the prevailing theory in political science was that if we interweave our supply chains tightly enough, war becomes literally impossible. The cost of conflict becomes too high.
You're referring to the McDonald's peace theory, the idea that no two countries with a McDonald's franchise have ever gone to war because the economic integration makes conflict irrational.
Right. You're the ultimate safety net. But this data proves that the interweaving doesn't prevent conflict at all. It simply provides new economic hostages to be executed when tensions flare.
It's a sobering thought.
Corporations are no longer just businesses operating in a borderless world. They are political hostages that can be sacrificed at a moment's notice when national security clashes with economic efficiency.
And because of that, the trust that built the globalized world is gone. The data on mutual trust between these two specific nations is staggering. Back in the 1970s, during the era of panda diplomacy and the opening of relations, roughly 75% of Japanese citizens felt friendly toward China. There was optimism.
And by the time of the 2010 boat collision,
that number had plummeted to a chilling 20%. You cannot run a frictionless, highly efficient global supply chain on 20% trust. It is impossible. Low trust requires endless layers of hedging, redundancy, alternative suppliers, and risk mitigation, all of which destroy the very efficiency that made globalization profitable in the first place.
Which brings us to our final thought today. I want to turn directly to you, the listener, right now. We have just walked through a forensic mathematical reconstruction of two events that happened roughly 20 years ago, a textbook edit in 2005 and a fishing boat bumping into a Coast Guard vessel in 2010.
Relatively mild political conflicts in the grand scheme of human history. Nobody fired a missile, no borders were invaded, no embargoes were declared.
Exactly.
Yeah.
Mild conflicts that nonetheless caused unrecoverable, symmetrical, multi-billion-dollar bleeding across two interconnected superpower economies. It destroyed real physical profits, wiped out market caps permanently, and scarred supply chains. So here's the ultimate question you need to ask yourself as you look at the news today. If that is the damage a minor conflict caused 20 years ago during the absolute peak of the globalization honeymoon, what exactly is the bill going to look like today?
We are living in a world right now that is actively screaming for decoupling. Nations are openly subsidizing the shattering of supply chains. The rhetoric is 100 times more hostile than it was in 2005. The global trust deficit is at a post-World War II high.
We have moved completely out of the era of cold politics, hot economics. We are heading straight into the absolute ice age of cold politics, cold economics.
When the next geopolitical spark flies, whether it's over semiconductor exports or a trade tariff dispute or a territorial claim, it won't just be a stock market correction. It won't be a temporary dip that the institutional investors buy their way out of.
It will be a total, agonizing rewiring of the global economy.
And the data from Fisman, Hamao, and Wang proves, unequivocally, that neither side wins that rewiring. Both sides suffer symmetrical, devastating, permanent punishment.
So as you look at your own portfolio, your company's supply chain, or your industry, you have to ask, are you prepared for the freeze? Because the financial x-ray is broken, the diagnostic waters are muddy, and the comforting myth of capital protecting itself is officially dead.
It's a sobering reality, but understanding the mechanics of how this destruction happens is the only way to prepare for it.
It really is. The rules of the game have fundamentally changed. Thank you for exploring this incredibly complex, mathematically rigorous, and somewhat terrifying topic with us today. Until next time, keep questioning the consensus, keep digging into the data, and we'll see you on the next Deep Dive.